Welcome to Volatility Trading Strategies. So if you've been following my work for a while now, you're probably familiar with my origin story, so to speak, so I won't bore you with the long version of that. But the short version is pretty simple. For many years before I started my business, I was just a full-time trader. That's how the VTS community all started. I take what I already do for myself, and I find ways to share that with the public. If people want to listen and follow along, then that's great, they can do that. And if not, of course there's plenty of other people out there with their own take on how to invest successfully. But that experience, that pressure of having to make a certain rate of return just to meet my monthly expenses was very valuable. And side note, for anybody out there who actually does want to succeed in the asset management world and learn how to make real money for their clients, rather than just charge fees and talk about it, I strongly suggest they live that trader lifestyle, at least for a little while. Not forever, obviously that's unsustainable when you're constantly pulling money out of a trading account to spend, but for a few years, those lessons learned can be invaluable. I did it for 6 years, and I think above all else, the number one lesson that I learned going through that experience was that it's far more beneficial to avoid taking excessive losses rather than actually chase the big gains. Let me illustrate what I mean. So one of the unfortunate realities of the financial industry is that actually a fairly small percentage of professional asset managers actually know how to trade and make money. And this goes for some of the subscription services you see out there as well. Now, I don't say that with malice or insult. I certainly don't want to come off as sounding negative towards my peers. And there's plenty that people can learn from those people. But the truth is, most of them are just marketing professionals. A very small percentage of them have actually ever been dependent on their monthly returns to pay their rent. And that's my point. That's what this series is about. Most of the people out there are spending their time marketing the big gains, because that's what sells, right? Big profits. When the markets are going up, maybe it's up 10 or 15% in a 2 or 3 month stretch, there's no shortage of people on YouTube and Twitter who will tell you that they made twice that much. But when markets don't cooperate, those same people are pretty quiet, aren't they? And in fact, some of them just go radio silent until the markets recover. But like I said, the number one thing that I learned over those years when I was trading for a living and being dependent on those returns to pay my rent was to prepare for and actively avoid those bad periods. Because if real money is on the line, you can't just disappear and come back when the markets are ready to cooperate again. This is an incredibly crude illustration, so forgive me, I'm not a graphics design person, but I hope it illustrates my point. So imagine this black line is our basic underlying stock market index. Markets do go up over time, but they also suffer significant corrections along the way. This is normal. So for the vast majority of investors who are focused on making bigger profit, during those up periods in the market, they can find ways to make more. Remember, if you're only focused on boosting return in good times, then it's really not that hard to do when markets cooperate. The problem is when there is a correction, everything is a double-edged sword. If you put on more risk to make more during good times, that will lead to bigger losses when markets go the other way. Remember, aggression, risk, leverage, it all goes both ways. So the aggressive trader makes more, then loses more, but they aren't back to break even compared to the underlying, are they? This is a mathematical truth that affects a lot of aggressive investors. So let's take a simple example. If you start with $10,000 and you make 50% this year, and then you lose 50% next year, are you back to break even? Up 50, down 50 should be the same, right? Well, a 50% profit on $10,000 takes it to $15,000. And then a subsequent loss of 50% takes that $15,000 to just $7,500. So actually over the 2-year period, you're down money, you're down 25%. And if you reverse that order, down 50, up 50, it's still the same result, still down 25%. So the trader that is aggressive, chasing those big gains, does end up making more during good times, but they give it back during bad times. And in the long run, there's a mathematical bleed built in, because losses are more costly than gains are beneficial. I'll say that again because it's a very easy statement to remember, but very important. Losses are more costly to a fund than gains are beneficial. This is a basic chart showing the rate of return necessary to reach the break-even point after suffering a drawdown. Notice how it gets exponentially worse the larger the drawdown gets. This is why it took most investors many years after the financial crisis in 2008 to actually break even. Losses of 30 or 40% can take years to recover from. But what I focus my investing on is picking up on the signals that allow me to exit trades before any of the major damage is done. In some of my strategies, that means moving to cash. In others, it may mean moving to safety positions like bonds or gold. But reducing the impact of those drawdowns actually means a better rate of return in the long run. Now, sometimes this focus on risk management does mean a little lower rate of return during good times. That's why I've made the slope of this line a little flatter, reflecting that a strategy doesn't quite keep up to the underlying in good times. But in the long run, drawdown reduction in safety positions means that with each subsequent correction in the market, it leads to a larger and larger effective rate of return. In the end, the conservative trader does come out way ahead. I know it's not the most exciting way to trade, and it doesn't give me much marketing material to go bragging about on Twitter, or to make those YouTube videos, watch me make $4,000 in 30 minutes nonsense. And I do say nonsense because if they just let the video run for a little while, as soon as the market stopped cooperating, guess what happens to the 4,000 they just made? But of course that part gets conveniently edited out. So yeah, my style of conservative investing can be a little bit boring. But in my opinion, that is the most effective way to invest. Hanging on to profits by being sensitive to the fact that markets do move in both directions is the only way to succeed in the long run. It's a slow process and it can take a while to see it working. But like I said, with each successive market correction, if the trader just avoids even half of the drawdown, then even if they don't make quite as much as the market when it's going up, it doesn't matter because the money saved far outweighs the opportunity lost. The last 6 months has been a perfect illustration of this. The markets did suffer one of the worst quarterly drawdowns since the Great Depression in the fourth quarter of 2018, and I can tell you that very few people were bragging on Twitter during those 3 months. It was mostly deer in the headlights, just waiting to see if the disaster will be averted. And as it turns out, it was. It's 4 months later now, and markets have recovered what was lost. And wouldn't you know it, Twitter is getting very chatty again. A lot of managers out there talking about how great their Q1 2019 has been. I guess we're just going to gloss over the fact that they are coming off their worst quarter in a decade just a few months ago. Most are still down money over the 6-month trailing average. But of course they only talk about the recent recovery. But again, if a trader just avoided, say, half of that drawdown, or maybe 2/3 of the drawdown, they'd be at a pretty great starting point to capitalize on some of the recovery. For me personally, I exited my stock positions on October 5th and moved into bonds. I didn't have any drawdown at all, and in fact I made a little profit during the crash because bonds have done fairly well in the last 6 months, mostly thanks to the Fed rate hike capitulation silliness. But this isn't about me, this lesson is for everybody. Avoiding losses is definitely more important than chasing big gains. And from an investor psychology perspective, this is definitely true. Focusing on risk management and preserving emotional capital leads to a far less stressful life. Remember, investing is forever. It's not a 1 to 2 year thing. We're not just trying to swoop in and make a big profit and then sail away into the sunset. We invest throughout our lifetimes. It never ends. Cutting down on those gut-wrenching drawdowns stabilizes your mood when it comes to finances, and will allow you to make better decisions when it counts. But also, from a mathematical perspective, taking half of the negative, even if it is at the expense of some of that positive, still adds up to a better long-term rate of return. That's just how the numbers work out. So take it for what it's worth, but my experience has taught me to be okay with not chasing big gains, to occasionally give up on those opportunities in order to produce the best long-term rate of return. The financial industry, though, unfortunately, is mostly made up of sprinters. But myself and my fellow VTS community members, we're marathon runners. So if you want to know more about what I do, head on over to my website and claim your free trial and open yourself up to a potential shift in the way you view investing. Thanks for watching. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.